Hello everyone, this is Bhavik Chokshi here and I hope you guys are doing great. This is a revision video for Ind AS 33 on EPS. Over here we'll do a quick revision of the entire standard. We'll not do the sums here. If you're interested in the sums, you can go to the 5-part videos that we have shared on YouTube along with the concept notes and questions and answers, where we have discussed the sums as well as the concept. This is a quick revision of the concepts for Ind AS 33. We have taken the same theory note as a base, though I'll not be referring point by point over here because this is more of a revision video. Okay, so let's get started. Ind AS 33 is on EPS. It's an important standard. If you get a question on this, it will be a numerical question, solving type of a question and not theory or case based. So there are two types of EPS. There's something called as basic EPS, then there is something called as diluted EPS. Both of these EPS have to be disclosed on the face of the income statement, both your standalone financials as well as your consolidated financials, and it is very important number. So there is a separate guidance given in the form of Ind AS 33. First, we try to cover basic EPS. What do we mean by basic EPS? Well, basic EPS would refer to the earning per ordinary share. Ordinary share would mean regular equity share. Now, there can be certain instruments which have the potential to become equity shares. We don't consider them. There may be some perpetual preference shares. We don't consider them. We will consider only legal equity shares over here in the basic EPS calculation. So when we calculate basic EPS, in the numerator, we take the net profit available for equity shareholders. Now, equity shareholders get the money at the end after paying everyone. Employees, the salaries, the debt holders, interest, preference holders, preference, even after paying everyone, taxes to the government, the pool of money that is left over is called as the profit available to equity shareholders. This will be divided by the number of ordinary equity shares in order to give you EPS. Sounds easy. Now the problem over here is it might happen that the number of shares which usually appear in the balance sheet are as on date, that is on 31st March, let us say 2022. However, the profit is for the year 21-22. So the numerator is a for the year concept, whereas the denominator is as on date concept, and hence they are not directly comparable. So as a result, what we have to calculate is, first we do the denominator adjustment. What we have to calculate is the weighted average number of equity shares. So why do we do the weighted average? Because, well, the more the money a business has, the higher the profit they can earn. So if we have raised money at the start of the year and issued new shares, well, we have money for the entire year, and hence by default our profit is going to be higher. However, money is raised somewhere at the end of the year, then by default we have a lower capital availability for the entire year, and as a result we have to calculate weighted average number of equity shares, what is called as WANES. How do we calculate weighted average number of equity shares? Well, there are multiple methods possible, but typically we take the number of shares as on a particular date and then see for how long are they outstanding. So for example, there were 1000 shares at the beginning of the year, then 1000 into 12 by 12, then in October, let us say another 500 shares are issued, then these 500 shares are outstanding for 6 months, then 500 into 6 by 12, and so on. So the time-based weighted average will give you the WANES, weighted average number of equity shares. Now there are a few complex situations over here, like what if there are partly paid shares? Now partly paid shares should be converted into equivalent fully paid shares, and the way you do that is by comparing, let us say, the paid up value and the face value. So for example, you have 500 shares of rupees 10 each, which are rupees 5 paid up, then one can say that okay, 500 shares which are of rupees 10 each but 5 paid up are equivalent to 500 into 5 by 10, that is 250 shares fully paid, and hence you will take 250 into your overall calculation. So that will be the adjustment for partly paid shares. The next two adjustments are very important, one for a bonus and one for the right shares. Now, bonus shares are also fresh issues, and by default it means that from the date the bonus shares are actually issued, you should take them into the WANES calculation. The problem over here is bonus shares do not come along with any consideration. The entry for bonus shares is reserves account debit to share capital, and hence you don't get a single rupee additionally. And as a result, though there are more shares, you don't have additional real capital. Yes, there may be additional share capital, but then your reserves reduce. And hence, bonus is considered to be a mere book entry. And hence, in order to ensure comparability, in order to enhance comparability, we say that, well, for all practical purposes, bonus shares were always in existence. Yes, they may be earlier appearing as reserves. They were not shares, but the capital was always there in the company. And as a result, if in the current year bonus shares were issued, let's say you have 10,000 shares and 1:1 bonus is issued, so you now have 20,000 shares, but in the last year you had 10,000 shares. So by default, your comparison between the last year and current year gets distorted. Even if the profit remains the same, so let's say profit was 1 lakh rupees in the last year, 1 lakh rupees in the current year, it might happen that the EPS of the last year is 10 rupees and the EPS of the current year is 1 lakh divided by 20,000, that is 5 rupees. One can conclude that probably the company's performance has fallen. Well, no, it has not. It is just that it has issued bonus shares. And as a result, bonus shares have to be retrospectively adjusted from the earliest reported date. So you can calculate a bonus ratio and multiply that bonus ratio to the number of shares that are existing prior to the date of the bonus. You will directly multiply them. So if the bonus ratio is 1:1, that is 1 share becomes 2 shares. Then 2/1 will be the bonus ratio, which you can multiply for the shares which were even existing prior to bonus. So in the last year you had 10,000 shares, 10,000 into 2/1 will be 20,000 shares, and you will restate the EPS. Sir, but the financials of the last year have already been filed. Perfect. So you don't have to alter the last year's financials, but in the current year's financial statement, when you prepare the earlier year's column, that is when you will restate the EPS. The treatment for bonus is similar to the treatment that you do for share split, to the treatment that you do for share consolidation, because these are also issue of shares without consideration. Next comes right shares. Now right shares are issued for a consideration, and as a result the treatment over here should be similar to the shares which are issued for consideration. That is, you will take the right shares from the date they were actually issued into the Bain's calculation. However, the right shares almost always are issued at a discount, and hence there is a hidden bonus inside the rights, and hence Ind AS 33, AS 20, both of them require you to make an adjustment for the rights. How do we make an adjustment for the rights? The idea over here is to find the hidden bonus element. And how do you do that? Well, you find the theoretical X rights price, which is calculated as a weighted average price. So for example, the rights ratio is 1/4, and you have let us say the pre-rights price as 150 and the rights issue price is 100. So one can say that, well, 150 rupees ke 4 share plus 100 rupees ka 1 share. So your total investment is, I guess, what, 700 for 4 plus 1, that is 5 shares, and hence ideally 140 should be the price after the rights. Now if you are aware, the price, whenever there is a bonus, the price falls. So if there is a bonus of 1:1, then if pre-bonus the price was 150, post-bonus the price becomes 75. In a similar way here, we don't see a clear bonus. However, if pre-bonus the price is 150 and if all else remaining constant, the price is falling to 140, that means that fall will kind of guide us to the hidden bonus element, and that will be, let us say 1.05 or jo bhi number of that is called as a rights adjustment factor, which is very similar to the bonus adjustment factor, and that rights adjustment factor will be multiplied to all the shares which are outstanding prior to the date of rights. So this is something which I would want you to practice. So calculate the theoretical X rights price, which is the weighted average price, then rights adjustment factor, that is the price pre the rights issue and pre the right share given out, and theoretical X rights price, that will give you the rights adjustment factor. Multiply the RF to the shares which are outstanding prior to the rights. After the rights is over, you will include the right shares into the calculations. Acha, this is largely focusing on the denominator of the basic EPS calculation. When you look at the numerator, in the numerator you have to subtract everything, all the cost, all the expenses. The challenge over here largely arises in case of preference. Now when you look at preference shares may be classified as a financial liability, generally the case in case of cumulative redeemable preference shares, or in certain cases it might also be classified as equity, like an irredeemable preference share with discretionary dividend can be classified as equity. In the numerator, you have to remember that you have to take the value after preference dividend. Sir, but preference shares are equity. They are equity, but they are not equity shares. EPS is earning per share. It is not earning per equity. It is earning per share. So it is earning per equity share, and hence preference dividend has to be subtracted. Achha, if preference shares are in the nature of liability, then the preference dividend paid to them will be like interest and will be considered as a part of finance cost, and hence the net profit that you see will already be after deducting preference dividend, and hence you don't have to make any other adjustment. However, if the preference shares are in the nature of equity, then the dividend paid to them will be in the nature of an appropriation, and hence it would have been subtracted from the retained earnings. It would not be a part of finance cost. However, while calculating EPS, you still need to subtract that, and hence you will take the net profit minus the appropriation minus the preference dividend, which has not been taken in finance cost but which will have to be separately deducted in order to find the pool of money which is available for equity shareholders. So this is the adjustment that you have to do for preference dividend. For cumulative preference shares, you will have to deduct the preference dividend whether it has been declared or not, because it is a liability, it accrues. Non-cumulative, you will deduct only if it is declared. Now, premium or discount on early redemption or settlement of preference shares. Here the treatment is slightly contentious. It is debatable in my opinion, but nevertheless in line with the institute's solutions, and we have kind of clarified that as well. If there's an early redemption which happens of these shares, institute assumes that the gain or loss on early redemption would have been taken against the retained earnings, and hence you have to subtract that separately. In my opinion, that is not always correct, because ideally if there's an early redemption also, you have to figure out whether that preference share was in the nature of liability or equity. But nevertheless, institute assumes that it would have been going in the retained earnings, and hence we should deduct them separately. For consistency, we follow the same treatment. For early conversion, it assumes that whatever is the gain or loss on early conversion would have gone into the profit and loss account, and hence no separate adjustment is done. So this is a slightly contentious point, but for the timing, we follow the way the institute has solved. When we look at certain items like preliminary expenses or certain premiums on redemption of debentures, etc., as per Indian law, you are allowed to reduce them even from some reserves like securities premium. So this gives rise to an alternative treatment where some companies might reduce, let us say, a preliminary expense from securities premium, and some of them might reduce it from P&L. The standard here says that irrespective of where you have reduced it, from the P&L or securities premium, if there is an item which is permitted to be reduced either from the P&L or from some other reserve, irrespective of where you have reduced it, it should be reduced from the net profit available for equity shareholders. So if you have reduced it from the P&L only, preliminary expenses, then no problem. However, if you have reduced it from securities premium, which is legally permissible, then while calculating EPS, you will have to subtract that preference, preliminary expenses written off or underwriter's commission written off against securities premium in the numerator separately. Okay, so that largely takes care of the basic EPS. There is an additional guidance, an appendix which is given under Ind AS 33 for participating preference shares. Now this is important because it's a new guidance, not there under the older standards. Participating preference shares refer to preference shares which participate in the profits based on agreed formulas. Now, what might happen is, if you're trying to find the EPS for an equity share only, you would say that, okay, we will pay the fixed preference dividend, and then whatever is the pool of money which is available belongs to the equity shares. Whether you distribute it or not is irrelevant. That pool of money is available to equity shares. So, for example, if you have earned 1 lakh rupees and from that you have paid 20,000 as preference dividend, then 80,000 is available to pay equity shareholders, and you calculate EPS as 80,000 divided by the number of equity shares. However, if there are participating preference shares, then you have to acknowledge that a part of that 80,000 will also be given to the preference shares. And hence, if you have to do the workings, it has to be done in a slightly different way. So, sir, how do we do it? Well, we try to find the undistributed profit, the profit that has not been distributed. For example, over here, the law says that, or the agreement says that from the profit, first preference dividend has to be paid, let's say of 20,000. After that, equity dividend has to be paid, let us say hypothetically of 10,000, and then whatever is left over will be shared between the equity and preference shares in a particular ratio. Then the first step over here is to find the undistributed profits. The undistributed profits over here would be 1 lakh minus 20 for going to the preference shares, minus 10 going to the equity shares, and then 70,000 is the undistributed profit. Now, this undistributed profit has to be allocated between equity and preference shareholders based on an agreed ratio. You can say, the question might have said that preference shares will get 50%. Each preference share will get 50% of what the equity shareholder will get. So we can say, let the earning going to the equity shareholder be X, in which case the earning going to the preference shareholder will be 0.5X. that is per share. So you will multiply it by the number of preference shares and multiply X by the number of equity shares. That will give you the total pool of money. So for example, if there are 5,000 preference shares, then 5,000 into 0.5x and 10,000 equity shares and 10,000 into x, that will give you your undistributed profit, that is 70,000. So if I were to distribute 70,000, how much will go to preference, how much will go to equity? You will find x, and through that you will find 0.5x. So you will formulate an equation like we have done, and then find that if the 70,000 is distributed, how much of the 70,000 will go to the preference share, how much of it will go to the equity share. So for example, if this is 2,500x, this is 10,000x. If I were to, I don't think, okay, chalo, I have a calculator here. So this is 70,000 divided by 12,500. So this is 5.6 is x, therefore 2.8 will be 0.5x. So if I want to find the EPS, EPS will be for the equity shares and participating preference shares separately. We will say that the amount which has been distributed, well, we have distributed 10,000 rupees to equity shares, to 10,000 equity shares, so the amount distributed is 1. And to the preference shares, there are 5,000 preference shares, जिसको हमने 20,000 दिया था, 1 lakh minus 20,000, and hence 4 rupees was distributed to the preference shareholders. This is fixed distribution. And after that, undistributed profit has not been distributed. But if it was, then every equity shareholder will get 5.6 and every preference shareholder, for example, will get 2.8. And as a result, the total earnings from that pool of money will be 6.6 for equity and 6.8, for example, for preference. I've just tried to do it in numbers to the best extent possible, but you should revise sums on this. It will really be helpful. Okay, so that takes care of the first section, which is on basic EPS. Next, you go to diluted EPS. Now, what do you mean by diluted EPS? Diluted EPS refers to the worst possible EPS that an entity might get. It is hypothetical, it is notional. It is a worst possible EPS if all the potential equity shares that are there are also converted into actual equity shares. Sir, nahi samajh mein aa raha. What do you mean by potential equity shares? Potential equity shares are those instruments which have the potential to become equity shares. For example, convertible preference shares, convertible debentures, options or warrants, contingent shares, all of these have the potential to become equity shares, though they may not be equity shares as of now. Okay, so if they were to be hypothetically converted into equity shares, then what will be the impact is what we are going to study here. So let us first look at the impact from preference shares and debentures. Largely, the accounting for preference shares and debentures would remain the same. So to the preference shares, you will pay preference dividend, but to the debentures, you will pay interest. Preference dividend does not give you any tax savings, but interest does. And as a result, if let us say there is a company whose profit available to the equity shareholders, let's say profit available for equity shareholders was 10,000, this is PAT after everything, and the weighted average number of equity shares wins was 10,000, then the basic EPS is rupees 10. If it also has, let us say, a 9% convertible preference share, which is worth 1 lakh rupees. These are, let us say, 1,000 preference shares of rupees 100 each, and the conversion ratio, for example, is 1:1, and the tax rate, for example, is 30%. So over here, if these preference shares were to be converted into equity shares, the next question is from when will they be converted? Well, they will be assumed to be converted from the start of the year or the date of issue, whichever is later. So if the preference shares were in existence from the beginning of the year, then from the beginning. If they were in existence during the year, obviously from the date when they first came into the existence. So over here, we will say 1 lakh rupees. But this 1 lakh rupees is after deducting everything, the preference dividend, interest, everything. But if they were to be hypothetically converted, then interest, the preference dividend will no longer be paid. So this is 1 lakh into 9%, that comes to 9,000. So you will add 9,000 over here. Acha, let us say the conversion ratio, let me just change this a little, is 10:1. So the conversion ratio is 10:1. So one preference share gets converted into 10 equity shares. So over here, or so 1:1 be, we can keep 1:1, no problem. 1:1. So over here, let us say 1000 preference shares will convert into 1000 equity shares, and as a result, if preference shares were to be converted, then 1,09,000 will be the profit and 11,000 would be the shares. So 1,09,000 upon 11,000 will be 9.91. So this will be the diluted EPS. Your basic EPS was 10. The diluted EPS over here is, let us say, 9.91. The accounting will be exactly the same even if you have debentures, just that instead of preference shares, if there are debentures, then if this 9,000 was not paid, then your profit, the taxable profit, will increase by 9,000, and hence it will result in some tax, additional tax. And as a result, we'll say, well, if the 9,000 is not there, then the tax savings on 9,000 will also not be there. So this is 9,000 into 0.7, 6,900, and you have 1,06,300. So this will give you the diluted EPS. Okay. So this is 9.66 or something. Fair enough, nothing much. You have to remember that we have to consider all the possible impacts from the conversion, not just interest. If, let us say, there is a managerial remuneration, then if interest is not paid, then the profit for managerial remuneration will also change, and hence the managerial remuneration will also change, and so will be the tax on that. So you have to consider all the possible impacts. Ajay, here if we alter the illustration and say 19% is the convertible amount, then what will happen? Well, all else remaining constant, this is 19,000 into 0.7. So this is 19,000 into, let us say, 0.7. This is 13,300. So this will be, let us say, 1,13,300 upon 11,000, and hence ideally the diluted EPS would now be 10.3. Can this be the diluted EPS? No. The word diluted is a one-sided word. It means, diluted means reduced EPS. Stake dilution, that is stake reduction. So it is a reduced EPS. The standard does not call it as potential EPS. It says diluted EPS, which means if I were to include potential equity shares, my EPS should ideally fall. If it does not fall, then it is not diluted. If it increases, it is actually anti-dilutive, and hence it has to be ignored. Then we assume that the preference shares or debentures, as the case may be, are not dilutive. In fact, they are anti-dilutive. They have the potential to increase the EPS, and hence they should be ignored. So only those securities which reduce the EPS should be considered. So over here, diluted EPS is the worst possible EPS. There are various types of potential equity shares. You will include them for the period they were potential, that is from the start of the year if they were in existence till the end of the year if they are still potential, and if they were converted or redeemed during the year, then up to that date. So for the period they were potential, they should be included. One important thing which the institute can test you on, and I believe the institute will love to test you on, is the interplay between Ind AS 33 and Ind AS 109. Convertible preference shares or convertible debentures necessarily are going to be compound financial instruments, and if they are compound financial instruments, then a question arises that what will be the interest to be added back in the numerator? Would that be the coupon interest, or would that be the effective interest? And when will I know that I have to calculate effective interest? I have to segregate the liability and equity component. Well, if the question specifically gives you the market rate of interest on similar non-convertible securities, like it does in Ind AS 109 for financial instruments, you have to necessarily find the liability component, equity component if you like to, and the effective rate into the liability component will be the effective interest. In your P&L, it is implied that you would have recorded the expense based on effective interest, and hence what you add back will also be the effective interest. Tax adjustment will be 1 minus t into the effective interest unless otherwise given. So you will take the effective interest, and that will happen only if the question specifically gives you a market rate of interest on similar non-convertible instruments. If it is not given, well, you cannot take anything. You'll have to take based on the coupon rate only. Sir, in the denominator, do we add back the equity component or so? No. In the denominator, you always have to add back the number of shares on conversion. So you don't have to think, okay, will conversion happen, will it not happen? That is not your prerogative. This is something which is to be done on the worst possible cases. So if the conversion happens, then what will be the impact? So you will take it. There have been questions in the past in the exam as well as in your study material where institute has given multiple conversion ratios. It has said that the conversion might happen into 135 shares or 120 shares or 115 shares or 110 shares. We don't know. So the standard over here says that you take the worst possible picture, which means which conversion ratio will result in the maximum possible dilution. Typically that is a ratio which is for a maximum number of shares. So if you have one share which is one bond which can be getting converted into 135 or 120 or 110, then we'll say 135 should be taken because that results in the maximum number of shares and hence the lowest possible EPS. So the maximum dilution. So this is something that you have to remember. So typically the adjustments for potential equity shares which are in the form of preference or in the form of bonds or debentures would be in the numerator. You add preference dividend. If there's DDT, then DDT along with that, but it has been abolished. If it is debentures, then you add back interest into 1 minus T if the tax rate is given. In the denominator, you will add the number of shares on conversion from the date of issue or the start of the year, whichever is later. Acha. Now, what if there are options or warrants? Ideally, one will say that the accounting has to remain the same. You will add the number of shares which are received on the exercise of options or warrants in the denominator. And typically, you don't pay anything to the option holder and hence nothing is to be added in the numerator. However, it is possible in certain cases that these options may be classified as liabilities, and if they are classified as financial liabilities, then fair value gain or fair value loss may be there. So that adjustment may come, but usually if nothing is available, then no adjustment is there in the numerator because like you pay the interest or preference dividend to the convertible preference shareholders or debentures, you don't really pay anything to the option holders. The challenge over here is, well, if I have 1000 options whose exercise price is 50 rupees, and if I assume a conversion happens at the start of the year, then I will actually receive money. At the start of the year, my journal entry will be bank account debit to equity share capital if options are exercised. On the contrary, if debentures or preference shares are exercised, your journal entry will be, let's say, preference shares capital account debit to equity share capital or debentures account debit to equity share capital. As a result, there is really no inflow of additional capital or money which is coming. However, in case of conversion of options, there is an actual inflow of cash that comes and you can't ignore that. You can't say, haan, theek hai, 1000 shares will be issued on exercise, but what about the 50,000 that you will receive on that exercise? So the standard over here kind of uses what you call as a treasury stock method. It says that, well, we don't know what can be done with that 50,000. So let us assume you will use that 50,000 to buy back your own shares. And that buyback will happen at the market price, the average market price during the year, for example, which is 80. In which case what will happen is you will issue 1000 shares on exercise of options. As a consequence, you will receive 1000 into 50, that is 50,000, which you will use to buy back your own shares at the rate 80. This is hypothetical. 1000 issue bhi nahi hua hai, na hi wo 1000 ke base pe buyback hua hai, but we are looking at potential impact. So this is 1000 minus 50,000 by 80, which comes to 625. So yes, you are issuing 1000 shares, you are getting some money, you are using that money to buy back your own shares, because otherwise different people might have different end uses. So we want to have a consistent end use, and hence 375 will be added in the denominator. What we loosely call as the free element on the options will be added in the denominator for the diluted EPS calculation only. Okay, so this is the free element, which is the shares issued on exercise, which is 1000 in our example. Number of options, that is 1000, into the exercise price, which is 50, upon the average market price, that is 80, and hence 375 will be added in the denominator. Okay, fair enough. The next thing, I mean, there is presentation and we will discuss that, but before we go to the presentation, the last potential instrument is the contingent shares. Now, contingent shares are shares which are contingent on a particular event. So for example, you have agreed to a business combination, and like Facebook has acquired WhatsApp, and Facebook has said that, okay, I'll pay you an X amount today, but the remaining I will pay you in shares after 3 years based on the performance after 3 years. So if WhatsApp's users cross a particular limit, then we will pay you, let's say, another 10 shares. If they cross a higher limit, then we'll pay you 25 shares. If even higher limit, then 35 shares, and so on. In which case, the issue of shares in the books of Facebook is contingent. However, there is a potential share because of this contract, there is a potential to issue shares. So how do you take that into the basic EPS calculation? Well, basic EPS says that till the date actual shares are actually issuable, you will not take anything. So at the end of the third year, when the contingency ends, from that date the shares become issuable, and that is when you will add them in the basic EPS calculation, nothing before that. However, diluted EPS says that, well, even if the shares are contingent, as long as the agreement has been entered into and is in place, the shares are potential, and hence they should be included in the diluted EPS calculation. Sir, from when? Well, from the date of the contingency agreement or the start of the year, whichever is later, because they become potential from the date the agreement is signed. Okay. But then there are various possibilities. You may issue 0 shares, you may issue 10 shares, you may issue 25 shares, you may issue 50 shares. How will you take that? Different people might have different estimates, and hence the standard says that, okay, if there is a potential equity shares which is in the nature of contingent shares, then if you are at the end of the first year, you will look at the users of WhatsApp at the end of the first year and assume that if the first year were to be the end of the contingency, if the first year were to be the end of the contingency, then what would be the number of shares to be issued? So for example, based on the users at the end of the first year, we have to issue 10 shares, then 10 will go in the diluted EPS calculation. At the end of the second year, we now believe that 25 shares are to be issued based on the users at the end of the second year, you take that. If you believe 0 shares are to be issued based on the users at the end of the second year, you take 0. No prior period restatement will need to be done because these are different estimates in different years. And as a result, diluted EPS will be calculated considering the current period to be the end of the contingency period. If year 1 was the end of the contingency period, then based on the actual facts in year 1, how many shares are issuable, those shares are actually potential and should be included into the diluted EPS calculation. Okay, so that is about contingent shares. There is a thing about presentation. On the presentation, we said that EPS has to be presented on the face of both the consolidated and standalone profit and loss statement. You have to show the EPS from continuing operations, discontinued operations if any, and total operations. Here there is also a concept of what you call as control number. Control number means that if there are various, you have to figure out whether a particular instrument, a particular potential equity share is dilutive or anti-dilutive. Now, if there are 3 EPS numbers, that is EPS from continuing operations, EPS from discontinued, EPS from total, you will be struggling to figure out that which of the 3 should I see in order to determine whether a potential equity share is dilutive or not. Ind AS 33 says the most important among the 3 is EPS from continuing operations, and if the addition of a potential equity share dilutes, that is, it reduces the EPS from continuing operations, then that potential equity share is considered to be dilutive and should be included in all the 3: continuing, discontinued, and total operations, irrespective of whether for the others it reduces or increases. EPS from continuing operations is what you call as a control number. Achha. Now, there is also one more thing. In almost every question the institute has, it has only one type of potential share in the calculation, but it is possible that there may be multiple potential instruments, in which case it might happen that if you take all of them together in one working, then you might not land up with the worst possible number, with the lowest possible EPS. And hence, in such cases, the standard actually gives you an order of ranking. It says that whenever there are multiple potential equity shares, you will take each potential share in the order of their dilutive power. Sir, what does it mean? Well, you will calculate what you call as incremental EPS. Now, incremental EPS is calculated as the cost saving divided by the number of shares. So, how much will you save if a potential instrument is converted and you divide it by the number of shares? Okay. So, for example, if convertible debentures are converted, how much will you save? Well, you will save the interest net of tax. If convertible preference shares are converted, you will save, let us say, the preference dividend. So for each of the instruments, options probably will save nothing. Each of the instruments you will take the cost saving in the numerator and divide it by the incremental shares that you will have to issue. So if the preference dividend saved is 9,000 and the new shares issued are 1,000, then 9 rupees is the incremental EPS. That is for every new preference share that gets converted into equity share, 9 rupees is the saving. But in options, if 375 shares are to be added, nothing is saved in the numerator, so 0 is the incremental EPS. So you'll calculate incremental EPS for each instrument and then rank them in the ascending order. The lowest coming first, the highest coming last. So the lowest number is that potential instrument which has the power to dilute the maximum, because there कुछ खास cost saving दे रहा ही नहीं है वो. And hence when you calculate the diluted EPS, you don't do it together in one shot, you do it, and we have given an illustration here, you can refer that, you do it on a step-by-step cumulative basis. So for example, I mean, I'm not reading the entire illustration again, but I mean, you can refer it, you can pause and refer the example. The incremental EPS is calculated for preference shares, for example, is 12. For debentures is, for example, 0.2. So debentures have a higher dilution and hence debentures should be taken first. You calculate the basic EPS, which is 10, and then you only add the debentures. We say, okay, if debentures were converted, then 200 will be added in the numerator, 1000 in the denominator, and hence this comes to 1,211,000. So your EPS is 9.11, which is lower than 10. Okay, so this is dilutive. Now you take the second instrument, which is preference shares. If preference shares were converted, then 1200 will be added in the numerator, 100 in the denominator, and hence if you solve this, this will come to 9.14, which apparently is lower than 10, but it is higher than 9.11, and hence we will ignore the preference shares and say that the worst possible EPS is actually 9.11. So this is the order of ranking that has to be done in case multiple potential equity shares are there in a particular problem. Okay, so that I think kind of largely covers the important concepts of Ind AS 33. This is something that is to be read and understood better through numericals, through sums, and we have shared the sums which are there. So hopefully they do help. Let me know if this video was helpful, and please do press the like button if you have liked the video. Thank you very much, and I'll see you soon. You can subscribe the channel for more such updates. We'll try to upload more revision videos and more helpful content for your preparations. Goodbye, good luck, take care.